The Magnificent Seven stocks had a rather mixed performance in 2025. On one hand, you have both Alphabet and Nvidia, which delivered spectacular returns of 66% and 41% respectively. But on the other end, Microsoft, Meta, Apple, and Amazon all underperformed the S&P 500, which delivered a 16% return. So, are the Magnificent Seven stocks still investable for 2026? In this video, I'll go through each company and share what I think of them. Then at the end, give them a rating. So let's not waste any time and let's jump straight into the first name, Nvidia. In the third quarter of fiscal 2026, Nvidia reported $57 billion in revenue, up 62% year over year. Growth was slower than it was 2 years ago, but Wall Street still expects Nvidia's revenue to rise by around 50% next year, which is remarkable for a company of this size. And this does not even fully include China. Reports suggest that Nvidia may soon be allowed to sell advanced AI chips such as the H200 to Chinese customers again. If that happens, revenue growth could rise to as high as 69%, well above current analyst forecasts. What makes this growth even more impressive is its profitability. Nvidia posted gross margins of 70% and operating margins of 58%. Most hardware firms will never reach numbers like this. What it shows is that Nvidia is not only growing fast, but doing so with margins that look more like a software business. One big reason Nvidia can keep these margins so high is that it isn't just selling chips, it also sells the entire system that makes AI work, from the processors to the networking, the software, and the tools that developers use to build and run AI models. For customers, this makes setting up easier, but more importantly, it creates switching costs. Even if a rival offers a faster or cheaper chip, moving away from Nvidia would mean rebuilding the whole system. Once a company is deep inside Nvidia's ecosystem, leaving becomes expensive or even risky. And it doesn't just stop there. At CES 2026, Nvidia unveiled the new Vera Rubin AI computing platform, which it described not as a single product, but as a full design for how AI centers should be built. In simple terms, Rubin is Nvidia's blueprint for future AI infrastructure, covering chips, networking, and software all in one package. The company is also expanding beyond data centers. Its Drive platform acts as the brain for self-driving and advanced driver assistance systems. Car makers can use Nvidia's hardware and software to process camera data, control sensors, and make real-time driving decisions. Essentially, Nvidia is trying to become the operating system for future autonomous vehicles. Beyond cars, Nvidia is moving into industrial AI. At CES, the company showcased how partners such as Siemens can use Nvidia systems to run factories, control robots, and simulate real-world processes. This brings AI out of the cloud and into physical industries. Now, of course, Nvidia does face some real risks. In its earnings report, the company revealed that 36% of revenue came from just 3 customers. That means Nvidia depends heavily on a small group of buyers to continue to spend at a record level. So if even one of them cuts back, the impact could be huge. Then there's also the circular web of AI spending. Nvidia has signed huge long-term compute deals with companies like OpenAI and Anthropic, while cloud firms build massive data centers based on Nvidia hardware. So as long as spending continues, the system will hold. But if one major player delays projects or cuts budgets, the effects could ripple quickly across the entire ecosystem. Geopolitics also adds another layer of risk. Even if Nvidia could sell certain chips to China again, access to that market will still depend on both US and China policies. Export controls, political tensions, or sudden rule changes could disrupt sales at any time, making revenue from China hard to predict. Finally, large cloud companies continue to develop their own custom AI chips. While these alternatives may not replace Nvidia at the top end today, they can slowly reduce reliance on Nvidia over time, especially for inference and internal workloads. In short, Nvidia remains the dominant force in AI, with unmatched scale, margins, and control over the full technology stack. But its future depends on continued heavy spending from a small group of buyers, stable geopolitics, and an AI investment cycle that does not slow down. Because of that, I will give Nvidia an A rating. Quick pause. Today, the Magnificent Seven sits at the very top of the market, and they come with high volatility. But for everyday investors, the real challenge is not just what to buy, but when to buy and sell at the right price. And this is where Moomoo's advanced order features have been especially useful for me in managing my trades. For example, after Nvidia's Q3 earnings, the stock surged to around $195 before falling to a low of $175 within the same session. If I want to protect my gains after such a sharp move, I can set a stop limit order in advance. This helps me remove emotional decision making and stay disciplined when markets go crazy. Moomoo offers over 6 advanced order types, and you can explore all of them directly on the Moomoo app. New users who sign up to Moomoo SG will get to earn up to $1,315 worth of welcome rewards when you fulfill the terms and conditions, which includes a $60 worth of Nvidia shares. Plus, enjoy zero commission for US, Hong Kong and Singapore stock trading. Simply follow the steps here and key in my promo code Kelvin88 to get your exclusive reward. For more details of the promotions, do refer to the link promotion page in the description below. Next up, we have Meta. One of the biggest shifts in 2025 was Meta's decision to finally cut spending at Reality Labs, its virtual and augmented reality division. For years, this unit has been bleeding billions of dollars as Meta poured money into long-term metaverse projects that never really took off. Then in 2025, the company decided to cut budgets by around 30%, including layoffs and project reductions. At the core of Meta's business, AI continued to reshape advertising. Tools like Advantage Plus, automated creative generation, and AI-driven targeting help advertisers reach the right users more effectively. That led to higher return on ad spend, lifted engagement, and support stronger ad pricing. But more importantly, AI is creating new ways for Meta to make money beyond traditional ads. One example is business messaging on WhatsApp. Over the next few years, this is expected to become a meaningful revenue stream as small businesses use AI tools to reply to customers, manage sales, and handle basic support. At the same time, better recommendation systems are increasing the amount of time people spend on apps like Facebook, Instagram, and Threads. More time on these platforms means more ad impressions, and of course, higher advertising revenue. Hardware is also becoming more relevant for Meta. In 2025, the company saw strong demand for its Ray-Ban smart glasses, which sold out shortly after launch. These glasses are lightweight, easy to use, and offer practical features such as taking photos, recording video, and interacting with Meta's AI assistant. This was one of the first signs that wearable AI can appeal to everyday consumers and not just tech enthusiasts. But then, there are still risks. Reality Labs is not profitable yet, and there's no guarantee that AI glasses or VR headsets will ever become a major profit driver for Meta. There's also no guarantee of a clear return on investment on Meta's heavy spending on AI in the near term. And Meta continues to face regulatory pressure around data privacy, competition, and content moderation, especially in the US and Europe. Overall, Meta has shown that it can grow revenue, use AI to strengthen its core business, build hardware with real consumer demand, and invest for the future while becoming more disciplined on costs. Because of this, I will give Meta an A rating. Moving on, we have Alphabet or Google. At the start of 2025, many people were still worried that Google was being disrupted by AI. There were concerns that tools like ChatGPT would eat into search traffic and weaken Google's core business. But over the year, Alphabet's results show that it not only kept up with the AI shift, but is now helping to shape the next phase of it. In Q3 2025, the company reported $102.3 billion in revenue, marking its first quarter above $100 billion, while showing growth across all its segments. One of the clearest signs of change came from Google's cloud business. Google Cloud revenue grew 34% year over year to $15.2 billion, and the unit's operating margin expanded to 23.7%. This showed that the division isn't just growing fast, but also becoming more profitable. Even more important is Google Cloud's $155 billion backlog of contracted future revenue. This backlog are deals that customers have already signed up, but Alphabet has not recognized as revenue yet. This gives the company a long runway of predictable demand going into 2026 and beyond. Companies building large-scale AI models are also choosing Google Cloud's infrastructure, in part because of Alphabet's custom tensor processing units, or TPUs. These are chips designed in-house specifically for AI workloads. And because Google controls both the hardware and the software, it can train and run large models more efficiently than platforms that rely only on off-the-shelf GPUs. This gives Alphabet a real cost and performance advantage at scale. On the product side, Gemini has now been deeply integrated across Search, Workplace, Android, and other services. This helped Google to defend its core advertising business while opening new growth areas. In fact, analysts now describe Google as the sleeping giant in AI that has fully woken up. There were even reports that OpenAI flagged a code red internally after seeing ChatGPT traffic decline following Gemini's rollout. Beyond cloud, Alphabet's core businesses remain extremely strong. Search and YouTube continue to generate large cash flows, and in Q3, the company delivered net income of $35 billion, with earnings per share up 35%, even while it was investing heavily into AI infrastructure. This shows that Alphabet can fund massive AI expansion without sacrificing profitability. Then there's Waymo, Alphabet's autonomous driving units. In 2025, Waymo expanded robotaxi operations in several major US cities, which brings it closer to commercial scale. While it is still a small part of overall revenue, Waymo shows that Alphabet's AI capabilities aren't just limited to software, but they also extend into real-world physical systems, where very few companies have achieved meaningful deployments. As for risk, Alphabet still depends heavily on advertising, and any slowdown in ad spending would affect growth. Competition in cloud remains intense, with AWS and Azure still larger in market share. Regulatory pressure around search, advertising practices, and data usage also continues across multiple regions. Personally, I would give Google an S rating. Google ranks higher than Meta and Nvidia because it is able to combine three things at scale: a dominant cash-generating core business, a fast-growing and increasingly profitable cloud platform, and a full control of its AI stack from chips to software to products. It is not just riding the AI wave, it is shaping it. Next, we have Microsoft. In 2025, Microsoft doubled down on infrastructure. The company said that it would increase AI capacity by more than 80%, and yet demand for Azure AI still exceeded available supply. To meet that demand, Microsoft accelerated some of the largest data center builds in the industry. One of the most notable projects is the Fairwater AI data center, a 2 GW facility designed specifically for large-scale AI workloads and powered by Nvidia's latest systems. At the same time, Microsoft strengthened its long-term position through its partnership with OpenAI. In 2025, reports showed that OpenAI committed up to $250 billion in incremental Azure usage under a new agreement. This effectively locks Microsoft in as OpenAI's primary cloud provider for future large-scale deployments, while also driving sustained demand for Azure's AI services. What stands out about Microsoft's AI strategy is how deeply it is built into the tools companies already depend on. Copilot is now part of Windows, Office, Teams, Dynamics, GitHub, and Azure. In 2025, Microsoft said that Copilot usage grew more than 50% and that the broader family of Copilot tools reached over 150 million monthly users. Then there are of course risks. Microsoft's growth is not as explosive as Nvidia, and heavy spending on data centers could pressure free cash flow if demand ever slows. Competition in cloud computing remains intense, especially from AWS and Google. That said, Microsoft has one key advantage that few others can match: durability. This is a company whose products sit inside the daily operations of businesses, governments, and schools. We saw this during the 2022 downturn, when Microsoft revenue and earnings fell far less than most peers. Its customer base is sticky, and as AI becomes widely used, Microsoft's tools are being added directly into the systems that already run in global organizations. And that's why Microsoft earns an A rating. Its growth may not be as dramatic as Nvidia, but it is more stable, more diversified, and far more resistant to economic cycles. Moving on to Amazon. If you only look at Amazon's share price in 2025, you might think that nothing much was happening. But beneath that surface, Amazon actually had one of the strongest strategic years in a long time. On the AI side, AWS continued to scale aggressively. In 2025, usage of Trainium grew 150% quarter-over-quarter, and management said that capacity was fully subscribed. That demand shows up in deals as well. In 2025, AWS reported more than $200 billion in remaining performance obligations. This means a massive amount of future revenue is already locked in, which gives AWS strong visibility going forward. Supporting that ecosystem, Amazon built one of the largest AI clusters in the world for Anthropic, powered by more than 500,000 Trainium 2 chips. At the same time, Amazon continued to grow its high-margin businesses. Advertising revenue rose 22% to $17.6 billion, making it one of the fastest-growing segments of the company. Ads are now deeply embedded across Amazon's shopping platform, Prime Video, and the third-party marketplace, turning traffic into profits in a way that traditional retail never could. Meanwhile, Amazon's regionalization strategy optimized its fulfillment network so that inventory is stored closer to customers. This lowered delivery costs and increased speed at the same time. By 2025, Amazon had expanded its same-day and next-day grocery delivery to over 2,000 cities, supported by growing use of robotic fulfillment systems inside warehouses. This is not just about efficiency, it creates a moat that few retailers can replicate. Amazon also applied AI directly to the shopping experience. Its Rufus AI shopping assistant helps customers search, compare products, and make decisions more quickly. That improves conversion rates and keeps users on the platform much longer, which in turn boosts both retail sales and advertising revenue. What makes this shift even more important is Amazon's financial profile. Cash from operating activities has doubled over the past 2 years to about $130 billion. After years of heavy spending on logistics, data centers, and infrastructure, Amazon is now entering into a profitable phase where those past investments are beginning to show up in stronger cash flow. As for risk, competition in the cloud remains intense, and capital spending on AI infrastructure is heavy. Retail margins are still thin compared with pure software companies. And while AWS and advertising are growing fast, any slowdown in enterprise tech spending or consumer demand could still affect parts of the business. But even so, I will still give Amazon an S rating. What makes Amazon different from most companies is that it is not built around a single product cycle or one technology trend. It is a system of businesses that reinforce each other: cloud, custom AI chips, advertising, logistics, and retail. It generates massive cash, reinvests at scale, and steadily expands into new markets. And while Amazon may not grow the fastest in any single year, it is one of the rare companies that could remain dominant 50 years from now. It is embedded in how people shop, how companies run their IT, and increasingly how AI systems are built and deployed. Next, we have Apple. In 2025, Apple leaned heavily into its long-term strategy of integrating AI directly into its hardware and operating systems. The launch of Apple Intelligence marked a shift in how Apple approaches AI. Instead of offering standalone AI products or cloud-first services, Apple embedded AI features into iOS, macOS, and its core apps, with a strong focus on privacy and on-device processing. This positioned AI as a product feature that enhances everyday use rather than a separate platform. Hardware remains central to that strategy, with the rollouts of devices powered by Apple's next-generation silicon, including the M5 chip. Apple emphasized tighter integration between custom chips, operating systems, and AI features. Financially, Apple continued to deliver what it does best: consistent cash generation. Even as growth in some hardware categories remained modest, Apple's services segment, including App Store subscriptions and payments, provided stable, high-margin revenue for the company. This allowed the company to keep returning large amounts of capital to shareholders through share buybacks and dividends, reinforcing its role as a dependable, low-volatility stock in a sector that's known for its big swings. Where Apple differs from its peers like Nvidia, Alphabet, or Amazon is in how directly it monetizes AI. Apple is not building massive cloud clusters for external customers, nor is it positioning itself as an enterprise AI infrastructure provider. Instead, Apple's AI strategy is consumer-focused and tightly tied to device sales and ecosystem lock-in. That means Apple benefits from AI mainly through hardware upgrades and user retention, rather than through new high-growth AI revenue streams. As for risk, Apple remains heavily dependent on the iPhone, and any slowdown in global smartphone demand can weigh heavily on growth. And while Apple's approach to AI is carefully designed and privacy-focused, it lacks the scale and revenue impacts of cloud-based AI platforms run by Microsoft, Google, or Amazon. This is why Apple increasingly looks less like an AI growth story and more like a defensive play. Its business model is built around predictable cash flow, strong brand loyalty, and an ecosystem that is hard for users to leave. Because of that, I will give Apple a B rating. Finally, we have Tesla. Tesla remains the most controversial name in the group, but it is also the one with the widest range of outcomes. In 2025, the stock continued to trade at a very high valuation, reflecting not just what Tesla is today, but what it might become if its bets on autonomy, robotics, and energy truly pay off. In 2025, Tesla continued to roll out full self-driving updates, with the company pushing toward unsupervised FSD and previewing version 14. Tesla is also aiming to remove safety drivers in Austin and begin robotaxi operations, with production targeted around Q2. If Tesla succeeds here, it would fundamentally change the business. Instead of selling cars as a one-time transaction, Tesla could operate a fleet of autonomous vehicles and even recurring revenue per mile. However, the challenge is that competition in autonomous driving is intensifying, with players like Waymo, Cruise, and several Chinese firms already operating in limited robotaxi deployments. Tesla's other moonshot is Optimus, its humanoid robot project. In early 2026, Tesla is expected to unveil the Optimus Gen 3, which Elon Musk has described as potentially the company's biggest product ever. The idea is that Optimus could be used in factories, warehouses, and eventually in homes, opening up an entirely new market beyond vehicles. At the same time, Tesla reported record deployments and improving margins in energy storage driven by demand for Megapack systems. The latest generation Megapack 4 integrates substation-level capabilities, which allows utilities and large enterprises to stabilize grids and store renewable energy much more efficiently. Energy is still smaller than automotive today, but it is one of the fastest growing and most profitable parts of Tesla's business. Tesla is also pursuing large-scale energy partnerships. In 2025, the company announced major projects in the Middle East, including collaborations linked to Saudi Arabia's energy transition initiatives, reinforcing the idea that Tesla wants to be more than a car company. But still, Tesla faces real challenges. Tesla's automotive business is facing intensifying competition, especially from Chinese manufacturers. In 2025, BYD overtook Tesla in global EV sales, which shows just how competitive the market has become. On top of that, Tesla continues to trade at a very high price-to-earnings multiple, which leaves little room for error. Any delays in robotaxi deployments, slower adoption of FSD, or setbacks in Optimus could have an outsized impact on the stock. And while Tesla's vision in autonomy and robotics is ambitious, much of it still remains unproven at commercial scale. For those reasons, I place Tesla last in this ranking, not because it lacks vision, but because of its extreme valuation and higher risk profile as compared with the rest. Tesla is a bold bet on robotics and autonomous vehicles in 2026 and beyond, but it is still a bet. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.